professor of finance at the Wharton School, Jeremy Siegel believes that stocks are close to the bottom despite ongoing volatility. Even though inflation rocked the S&P 500 last week, Siegel said that the index has probably already priced in a mild recession, and this should limit the extent to which the index can fall from its current position. Siegel stated that we're closer to the lows than the highs, but he acknowledged that his own research demonstrates that markets correct on average by 31% during a recession. This means that there may be more downside to the current stock market correction. And according to Goldman's Prime Brokerage, hedge funds, the so-called smart money, sold U.S. stocks for a seventh straight day Monday when the S&P 500 sank to a bear market. The dollar amount of selling over the Friday and Monday sessions exploded to levels never seen before by Goldman. That means even more selling than during the global financial crisis. What is also interesting is that gross hedge fund leverage is near 5-year lows, and Goldman Prime said that much of the action was hedge funds aggressively shorting stocks. While the stock market prices in a recession, the money supply growth is indicating we will likely have a recession. Recessions tend to be preceded by periods of slowing rates of money supply growth. And for context, as of April 2022, year-over-year growth in the money supply was at 7.23%. Now that's down from March's rate of 7.41%, but way down from April 2021's rate of 36.8%. So imagine what will happen when the Fed begins quantitative tapering. Let's take a look at our charts. First up here is the 2-year weekly chart on the Volatility Index, and as you can see in the upper left, the symbol is $VIX using stockcharts.com. Now, this chart seems to be getting more scary every week. We've talked about this before. This is a nice dish. If this were a stock or an indice, I would love to buy into it because we bottomed here in this period from say mid to late 2021, and then we started moving on up. You can see these higher lows stepping up. We got another step here. I'm not sure if it's going to carry on, but this is what I see. This is the danger in my opinion. This upward move or upward arc in these lows continues to head on up. Now, take a look. Even though I can't draw the line, you can see from this point here, we're at 32.69, but going here to the left or back in time, there seems to be a top where the VIX heads on up but gets reflected back down. Now, it's starting to look like a wedge or a pendant flag. So the further it moves up this chart here, it's starting to get pinched at this point over here towards the right. Now, it's not quite pinched yet, but it will be soon. And if that happens, then the VIX is either going to head up or down very strongly. With this upper move on this bottom trend line, my bet is that it's going to head up and break out of this top here. And if the VIX goes up, the stock market goes down. Now, there's no guarantee, no promise. I am just figuring in my own mind what the probabilities are. You can see here the RSI is very strong. Doesn't want to go below that 50 or midline, heading on up. Same thing here in the lower portion, the MACD. You can see that both the fast line and the slow line are above zero. They have strength, and it doesn't look like they want to subside. So back up here to the middle portion of the chart, danger with these movements on the way up, the stair step on the way up, and a possible breakout above here. I am telling you, save your cash, stack your cash, be prepared. Let's go to our next chart. And we're now looking at the 3-year weekly chart on the spiders, the SPY, and the close on Tuesday was 373.87. We continue down in this channel with the bottom channel line there and the upper channel line through here. So we may get another bounce here, but we haven't had enough strength to head up to the upper channel line, nor enough strength to break through. So we're very weak, and it looks like it's continuing to weaken. Here in the volume is moving down, which is a good sign, but the selling hasn't subsided, at least yet. And I think any stocks you're holding, you know that feeling. Here in the MACD, we see that the recent move here got reflected. And so the fast line is heading on down, and so is the slow line down below -10. Very weak. I don't see any sign of a bottoming yet. We'll get another attempt, but that's not here tomorrow. Tomorrow, we might get another rate hike. Down here into the histogram, you can see that the levels here and here certainly were not as low as we were here in the pandemic low, but two of these downtrends together means that this is still pretty serious on the downside. Moving here into the price rate of change, no real sign of any bottoming. It's still sawtoothing on its way down. Here into the relative strength index, we're a very weak 26.82. Again, no real sign of bottoming. This level here is above there, but I'm not going to call that a bottom sign, at least not yet. It's a potential, but not a probability. Here into stochastics, this shows you too that things continue to be weak, with the fast line moving up and then back down through the slow line. Weakness into this oversold territory. And then the Williams. This generally leads on the way down and on the way up, and right now it's leading on the way down. So I don't want anybody to panic. All I want you to do is be patient and then continue to stack your cash, because there are opportunities, but I'm not going to talk about a lot of opportunities until I see a better sign of a market bottoming and basing. And right now, I don't see that, especially with a potential rate hike on Wednesday, and then potentially rate hikes in July and September. But don't forget, quantitative tightening is coming soon as well. And for today, that's ChewDog Charts. Thank you.